I just closed my 5th mortgage assumption and my buyer got a 2.75% mortgage rate. Now, you're probably thinking it must be impossibly difficult, right? Well, believe it or not, it's much more achievable than you would imagine. And most industry stakeholders don't even pitch it because they don't make money off of it. And think about it. You don't need an appraisal. You don't need title insurance. It's more complicated for real estate agents, and mortgage brokers don't even get a new loan. There's no incentive for the industry to help you. So in this video, I'm going to pull back the curtain on assumable mortgages. We'll cover what it really takes to assume a mortgage in that 2 to 3% range. We'll debunk some of the biggest misconceptions, and to give you an idea of just how valuable a 2 to 3% mortgage is in today's market, let's take an example from my most recent buyer. He just got a 2.75% FHA $300,000 loan. His payment is about $1,425 for just the principal and interest, and the amount he's paying down in principal is about $600 a month. Now, partly because the loan is already 4 years old and it's got a low rate, even more goes to the principal. Now, compare that to a 6.5% mortgage, and you're looking at $1,945 a month with only $258 going towards principal on that first payment. That's almost a 30% lower payment with more than double the principal paydown in each monthly payment. So you're probably thinking, okay, if this mortgage is so valuable, I must have to overpay for the house to get it, right? This is the number one misconception, and it's completely false. In the 5 assumptions that I have personally closed, only once did my buyer pay list price, and it was the first one I did. In fact, on 4 out of the 5, we negotiated the price down, and in some cases, pretty significantly. My favorite example of this was a house listed for $740,000 earlier this year. Not only did my buyer assume a 2.5% mortgage, but we negotiated the sales price down by $50,000. From the seller's perspective, if their house was flying off the shelf with multiple offers, they would not need to offer the assumption. These opportunities typically arise when a property has been sitting on the market for a bit. This gives the buyer the leverage to negotiate not just the assumption, but the price as well. If it's such a great deal, what are the catches? What's the roadblocks? And there are 3 big roadblocks we need to talk about. The first is the down payment. Because the seller has been paying down their loan and the home is likely appreciated from 2020, 2021 levels, there's often a large gap between the sales price and the remaining mortgage balance. Now, to bridge that gap, you typically need a larger than average down payment or a second loan. Now, for a market like Nashville, I tell my clients that having around $200,000 in cash makes the process much smoother. But there are solutions if you don't have $200,000. And this does involve getting a second mortgage. I'll cover that in just a minute. Now, the second roadblock is the timeline. The timeline can be ambiguous. The process isn't instantaneous, and while every assumption I've closed has taken about 45 days, you need to be prepared for a 45 to 60-day closing window. There can be ambiguity, so there also needs to be flexibility. Let me just rant here for a second. You're getting a mortgage on a house that's already been appraised and underrented. You literally just need to qualify for a loan, and servicers act like we are moving mountains here. So there's literally nothing to do but replace someone's name on a mortgage with someone else that qualifies. So if you get pushback from the servicer and they act like what you're doing is a huge inconvenience, you need to throw it back on them. There's absolutely no reason a mortgage assumption should take more than 2 weeks. We still give them 45 days. Now, finding the listings, this is a big one. Not every home is assumable, but the ones that we're talking about here are the VA and FHA loans. They have guidelines issued by the government for assumption that the servicers have to follow. And the ones I've done are for owner occupants, people who are buying to live in the home, and that's generally the requirement on these. So now, VA loans, these are the ones that are the gold standard in my opinion. You do not have to be a veteran to assume a VA loan, provided the seller is willing to give up their VA entitlement to stay with the loan. The best deal I ever got for a client was a 2.25% VA loan with no mortgage insurance, and that's the key. VA loans don't have mortgage insurance like FHA. Now, FHA loans are also fantastic, but they do come with mortgage insurance. So you can think of MIP as adding about 0.8% to your interest rate. So if it's a 2.5% FHA loan, you're really getting about a 3.3% mortgage. And it's still an amazing deal, but the VA is the clear winner but they are also a little harder to get if you're not a veteran. You'll see far fewer listings that openly advertise whether they're assumable. My experience, out of the 5 I've done, only 2 were advertised. Multiple sellers didn't even know it was an option. In a market like Nashville with 10,000 homes for sale, there might be 300 or 400 that are technically assumable, but only 30 to 40 that are advertised. By the way, those 300 to 400, those are from 2020 and 2021, not every single VA and FHA loan. Now, there are a few ways that you can find these. One, if you don't have any resource or website like with Rome that actually shows a lot of the active listings that do potentially have these mortgages, you can go to wherever they record. Each county in the nation typically has these sites, and you can look them up manually. You need someone that's passionate and experienced because that becomes your superpower. They know how to find the unadvertised ones, and just as importantly, how to educate a reluctant seller and make them comfortable with the process. It's not just about identifying the assumable mortgage, but being able to set expectations with buyer and seller and instilling the confidence needed to make that happen. In fact, in the last one I did, the seller, even though they were advertising it, were very nervous about doing it. Now, second, prepare to deal with the mortgage servicer. Let's be blunt. The bank that services these loans does not want you to assume it. They make more money originating a new loan at 7%. You are not their priority. They may try to slow walk your application, quoting you 90 to 180 days. But here's your secret weapon. Servicers are regulated at the state level. You can and should politely but firmly inform them that you are aware of the regulations that require them to process your application in a timely manner. Both VA and FHA have requirements about 45 days from application. I've had to escalate this on a couple of my deals, and a simple email letting them know you're going to complain to the state made things move very, very quickly. You have to be your own advocate because these are life-changing maneuvers, and we don't have the luxury to sit on our hands. I don't like making big deals about these things, but I'm also not going to sit on my hands at the expense of my buyer. Now, let's talk about the down payment problem. If you don't have a huge down payment, you're not out of the game. A company called With Rome, and I'm a huge fan of their mission, specializes in helping buyers reduce the friction in mortgage assumption. They can connect you to lenders to get a second mortgage to cover the equity gap. And that second loan will have a higher interest rate, but you can create a blended rate that's still far below the market. For example, you might have a 2.5% first mortgage with an 8% second mortgage and end up with an effective rate in the 4s or low 5s. Even better, that second loan has no prepayment penalty, so you can aggressively pay it down. Your blended rate will shrink closer and closer to that original low rate over time. This process does require commitment from both buyer and seller. They have to be responsive and on top of the paperwork and communication. It does take the seller filling out an application, telling the servicer that the buyer is going to assume their mortgage, and it takes an agent who is proactive and, frankly, willing to be a little bit abrasive on your behalf when necessary. But I'll tell you why I'm so passionate about this. Every Thanksgiving, I know that 5 families are sitting around their dinner table and they have a story to tell about how they got their house, a story about how they secured a 2.75% mortgage when rates were 7%, locking in financial security for literally decades. And to be a small part of that story, it's an honor. It's one of the most fun things I do, and it's why I believe this is the most powerful strategy in a difficult market. And for everyone else, I wish you the best of luck in this market. Thanks for watching. I'll see you next Saturday.